Welcome back to Alpha Recap, your daily market rundown from stockalpha.ai. The market day wrapped up a little choppier than some investors hoped. And as always, if you have questions, you can reach us at stockalpha.ai. Jessica, great to have you on. Quick headline to kick us off. The S&P 500 closed down about 0.8%. The Nasdaq 100 dropped about 1.5%. And small caps actually managed to finish up about 0.25%. Walk us through that split.
Thanks for having me. That headline divergence was the story. The big cap tech-heavy index led the downside while small cap names ticked higher. It wasn't a panic, more a rotation. Investors trimmed mega cap growth exposure, especially names tied to AI platform and voice assistant narratives, and redeployed money into cyclicals like industrials, materials, energy, and some niche real estate and utilities linked to grid tech and storage.
When you say rotated, what did that feel like on the tape? Was it broad or pretty targeted?
It felt targeted. Large platform names came under renewed scrutiny around earnings expectations and execution on AI rollouts. That pressure pulled the headline indexes lower, but underneath you saw breadth improve because smaller, domestically oriented cyclicals picked up the slack. So instead of a uniform risk-off move, where everything sells off together, it was a rebalancing of where investors wanted exposure.
Let's dig into the numbers quickly. The Nasdaq 100 was down about 1.5%. That's a meaningful hit. What sparked that move?
Two things drove it. One, eyes were on tech earnings and messaging around AI and ad growth. Headlines calling out expectations for answers from major platforms on voice and Gemini-type integrations sharpened execution risk. Two, any hint that ad revenue or AI monetization could miss expectations tends to hit megacaps hard because they have high operating leverage. Small changes in revenue can swing profits a lot.
So while those big names were getting picked at, small caps popped. The Russell 2000 was up about 0.25%. Why did small caps benefit?
Small caps tend to be more tied to domestic economic activity, manufacturing, construction, local services. Today, you had strength in industrials and materials, plus selected energy and real estate financing names. That suggested investors were favoring exposure to firms that would benefit if capacity utilization and order books improved. So money flowed into those smaller cyclical players.
Walk me through the sectors. Which areas were clear leaders and why?
Industrials were one of the clearest leaders. We heard upgrades and positive chatter about order books, and an upgrade to Oshkosh from a big bank helped the whole group. Materials and mining had momentum, tied to constructive demand signals for commodities. Energy saw selective strength, not a broad oil-driven rally, but companies with disciplined production and strong cash flow outperformed. Utilities weren't trading as a defensive bucket. They were interesting for grid tech, storage, and solar-linked names. Finally, pockets of real estate finance and some selective financials also contributed to the cyclical bid.
That utilities note is interesting. Usually people think of utilities as a safety play, but you're saying targeted tech within utilities led the move?
Exactly. This wasn't classic defensive flows into dividend names. Investors were focused on companies exposed to grid modernization and battery storage. So the theme was more about structural investment and technology adoption rather than just safety.
On the other side, communications and big media names got hit. Alphabet headlines were in the mix. How did that play out?
Alphabet drew attention because investors wanted more clarity on AI integrations, Gemini, voice assistants, and how those products will monetize. That uncertainty around ad growth sustainability and product execution weighed on large-cap platform stocks and contributed to the broader weakness in communication services.
A couple of notable individual moves popped up in the article. PepsiCo did well, Pfizer had some positive clinical news, and Oshkosh got an upgrade. Talk to me about why those moved markets today.
PepsiCo reported broad-based sequential fourth-quarter growth, which reinforced the idea of a defensive consumer delivering steady revenues and margin discipline. Investors rewarded that. Pfizer had encouraging early readouts on a monthly obesity injection regimen, which provided a tangible biotech catalyst and lifted select pharma sentiment. Oshkosh benefited from a major bank upgrade and constructive commentary about truck and vehicle demand, which acted as a thematic anchor for the industrial sector.
There were some smaller filings, Transdig, Semileds, Sangamo, that popped up in 8Ks. You don't think filings alone were market moving, but they added to stock-specific flows?
Right. An 8K is basically a regulatory filing that flags material events. The filings themselves rarely move broad markets, but they can create idiosyncratic flows in those names, especially if the item is about corporate actions, leadership changes, or material contracts.
Let's bring the Fed and macro picture in. What did today's action imply about interest rate expectations and policy risk?
The market action reinforced a view that investors aren't expecting an immediate Fed pivot. The tech sell-off suggested that volatility in growth-sensitive large caps could give the Fed room to stay focused on data. Two implications stood out. First, traders seemed to assign a modest probability that policy would remain restrictive long enough to tame inflation without tipping the economy into a fast recession. Second, earnings season is starting to act as an input for policy. If tech platforms disappoint on ad revenue or AI monetization, that could influence how markets price growth and risk premia.
You mentioned earnings as a Fed input. That's a neat point. So, misses in big tech could change how investors view growth, and that in turn could affect the Fed's calculus?
Exactly. The Fed looks at actual economic activity and labor markets, but market signals and earnings can influence the risk environment. If several large platforms disappoint, and that feeds into slower hiring or capex plans, it can change the growth outlook and become part of the conversation around policy.
Technically speaking, the piece talked about breadth improving beneath the surface. What should traders be watching to see if that improvement is real or just a narrow move?
Keep an eye on intraday breadth measures and sector-level net advances. If the small cap and cyclical gains spread to mid and large cap constituents and are reinforced by earnings beats, that would suggest a durable shift. If the gains remain narrowly concentrated in a handful of names, then the headline indices could keep getting dragged by tech weakness. Options flow is another good read. If you see elevated put buying in the NASDAQ versus broader indexes, that signals ongoing risk-off positioning in growth tech.
You also put today in a historical frame, comparing it to rotation episodes in 2016 and late 2023. What's the takeaway from those analogs?
Those past rotations show that leadership can shift without a full-blown bear market, but confirming macro data and earnings are usually required for a sustainable regime change. In 2016 and the shifts we saw last year, the market needed either improving data that justified cyclical exposure or consistent earnings upside in the new leaders. Absent that, the rotation can stall and mega-cap pressure can reassert itself.
Okay, practical advice. For listeners who trade or manage money, what did you recommend they watch this week and next?
First, earnings follow-through in big platforms is key. Alphabet's report and commentary on Gemini-style integrations will be a big volatility driver. Second, watch the macro calendar. Upcoming inflation prints and the monthly jobs report can quickly change the policy narrative. Third, listen to Fed speak for nuance between patience and preparedness to act. And fourth, monitor breadth and options skew to see whether cyclical strength is broadening or remaining narrow.
If someone is positioned heavily in mega-cap tech today, would you suggest they hedge or rotate some exposure into cyclicals?
It depends on time horizon and risk tolerance. Tactically, some protection, like modest hedges around earnings windows, made sense given elevated execution risk. Strategically, a balanced approach that keeps some growth exposure while adding cyclical allocations could reduce concentration risk. The simplest practical route is to trim position size if a name feels overexposed and redeploy selectively into names with clearer earnings and balance sheet resilience.
Before we wrap, let's summarize the quick takeaways for listeners in plain terms.
Sure. 1. Today was a rotation day. The NASDAQ 100 led the decline, the S&P 500 fell less, and small caps finished the day up slightly. 2. Investors were trimming mega-cap tech tied to AI and ad revenue execution risk and moving into cyclicals like industrials, materials, energy, and targeted real estate and utilities exposure. 3. Watch platform earnings, upcoming inflation and jobs data, and Fed commentary for what happens next. 4. Breadth and options flow will tell you whether this rotation broadens into a durable leadership change or stays narrow and vulnerable.
Perfect. Jessica, thanks. Always great to get your level-headed take. For our listeners, if you want a deeper dive into any of the names or sectors we mentioned, or if you have specific questions about positioning, head to stockalpha.ai. If you have questions about anything we covered today, you can ask us directly at stockalpha.ai and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's it for Alpha Recap today. We'll be back after the next close with more perspective. See you next time.